Friends, today we are going to analyze 10 important decisions taken by the GST's 28th and 29th Council meetings. First and foremost, the order of utilization of ITC has been rationalized. This had occupied only one liner in the press release, however, it is very critical. We all know that CGST can be utilized first against CGST and then against IGST. Similarly, SGST can be utilized first against SGST and then against IGST. This order has been rationalized, and now IGST can be utilized before utilization of CGST and SGST in themselves. This is a radical change and would let a lot of input tax credit in the IGST ITC ledger get utilized. The 28th and 29th Council meeting were in sharp contrast to each other, wherein in the 28th Council meeting the rates of 100 odd items were reduced, and in the 29th Council meeting the Finance Minister pressed the pause button. There was a reason for that, because there was a deficit of around 43,000 crores quarter on quarter between the budgeted and the actual GST revenues. It is a fact that the GST Council has foregone almost 70,000 crore revenue by reduction in the rates in the last 1 year or so. Another critical aspect of the 29th Council meeting is the formation of a group of ministers for looking into the problems faced by the small and medium scale industries. This is the right opportunity for SMEs to come out not only with the procedural issues but even the regulatory changes which they would require. An example would be the solar cell industry, which was almost on the verge of shutdown due to the Chinese solar cells and modules becoming cheaper than the indigenous solar cells and modules due to the implementation of GST. After a long drawn representation before the Finance Ministry and multiple meetings we have had, Notification 1/2018 Customs was issued on 30th July to apply the safeguard duty on these solar cells and modules. It was a big win for the indigenous solar cell industry and has given a breather space to such industry. Similarly, other SMEs could now, in the next 1.5 months or so, approach the Finance Ministry and this group of ministers with their problems, and we are sure the ministry would take cognizance of such issues in case they are well founded. The reverse charge was an issue for the SME industry. The problem with reverse charge under 9(4) for GST payment by a dealer for purchases from unregistered dealers was that first one has to identify those purchases which are from unregistered dealers, then find the HSN codes, then find the GST rate, pay the reverse charge, and thereafter see whether input tax credit is available or not. It was resulting in a lot of hardship procedurally, if not financially. The GST's 28th Council meeting has proposed to implement reverse charge under 9(4) on only certain categories of dealers, which would certainly be the dealers with a higher turnover over a threshold limit. This is a very good step taken by the Council. Input tax credit has also been liberalized further. For example, the goods and services provided by the employers to employees which are required and mandatory under any other statute, the input tax credit for the same might be now taken. For example, medical aid provided to the employees by the employers. There was a confusion whether this would be treated as personal consumption or business expenditure. It has been said that such expenditures would be eligible to input tax credit. Further, motor vehicles with seating capacity of 13 or more would be eligible for input tax credit. The ITC on the purchase of motor vehicles plus goods and services in relation thereto would all be available to input tax credit. This is a big relief for industry. Schedule 3 under GST has gone through a dramatic change by addition of 3 important items. First, the supply of goods within the customs bond. Now, there was a confusion from November 2017 wherein the circular number 46 of the customs had come in and which has stated that in case certain goods imported are bonded in the customs warehouse whereby the duty or the tax is deferred, and within the bond, in case it is supplied by the importer to a third person, that would be treated as supply and would be liable for GST. There was clearly a double taxation, as when the person would clear it for home consumption from the bond, then again IGST would require to be paid. It would result in double accumulation of ITC without having an output in tax to set off such ITC. Now this sale of goods under bond, that is treated as neither goods nor service under Schedule 3. Similarly, high seas sale was always not liable to GST because it has happened outside the territory of India and outside the territorial waters of India. However, the next question to be asked was whether it is exempt supply, and if it is exempt supply, then ITC would be required to be reversed. Now this high seas sale has been brought under Schedule 3 and it has been stated that it is neither goods nor service. Similarly, where a goods has been purchased outside India and without bringing it into India, if it is sold outside India, such sale and purchase would be treated as neither goods nor service under Schedule 3 of the CGST Act. So Schedule 3 is a very critical amendment. In addition to Schedule 3, ITC would be allowed now on almost all items under Schedule 3, which is again a very good step forward. We all know that the GST returns are getting simplified. In fact, if there is one agenda, one single agenda of the GST Council in the months to come, it is simplification, simplification and simplification. We will have a further discussion on the new GST return which is out in public domain for public comments. However, one aspect I would like to discuss over here is that now under GSTR 3B, the dealer is allowed to first avail the input tax credit when he has the invoice, and thereafter within 2 months, in case the vendor does not file his return or files the wrong return or does not pay the tax, he has to reverse such ITC. Now in the new returns, the purchasing dealer would have to lock only those invoices which are appearing in his portal and which has been uploaded by the vendor. So this provisional credit has been done away with. Now, although we speak about simplification, on the other hand, working capital would get blocked. Another very critical element is that the credit notes and debit notes have been simplified, wherein a single credit note or debit note would be allowed for multiple invoices, especially in the case of pre-sale discount or turnover discount, as we say, wherein there are multiple invoices, and as of now the system GST portal is such wherein for every credit note you need one invoice, and it results in a huge number of invoices. Such procedural changes would be done, and now a single credit note would be eligible for multiple invoices. Lastly, there is a huge relief for the foreign companies which have either branch or HO in a foreign country. Now, wherein a foreign company which has its HO, say, in a foreign country and a branch in India, any service which is rendered by the branch to such foreign HO would be treated not as export of services under rule section 2 subsection 6 of IGST Act. Now, since it is not treated as export of services, therefore the normal rate of GST would be applicable, and the foreign party would not be allowed to take the credit because it is not registered in India. This would result in a loss of ITC to such foreign companies. This has been rationalized, and such supply shall henceforth be treated as exempt supplies.